US stocks rally on growing expectations, again, that the Fed will cut rates next month. There's another weak business sentiment survey out of the United States, and the Reserve Bank of India intervenes to stop the rupee falling. That's coming up in our 5 Things in 5 Minutes on Tuesday, November the 25th. And then in our deep dive interview, ANZ New Zealand's Chief Economist, Sharon Zollner, previews tomorrow's rates decision by the Reserve Bank of New Zealand. The market expects a 25 basis point cut.
If they don't cut 25, then the market response on the day could be quite violent.
But first, in 5 and 5 with ANZ, US stocks are rallying into the close again this morning as market expectations grow that the Fed will be able to cut again next month. The overnight swaps market is pricing in an 85% probability of a cut, up from around 40% a week ago. The surge started on Friday with comments by Fed New York President John Williams that a cut was needed, and there was more Fed speak to back that up overnight. As ANZ's head of G3 Economics, Brian Martin, reports.
And that firming in expectations was supported by comments from Fed Governor Waller that he advocates a 25 basis point rate cut in December, that the labour market is his concern, and that the FOMC can always become more cautious if the data so require. In fact, he did advocate a meeting-by-meeting approach after December. That very much aligns with our profile for FOMC cuts going forward. We forecast 125 basis point rate cut in December, followed by another one in March and a further one in June of next year, before we reach a trough for this easing cycle with the target of Fed funds between 3.25%.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 1.3% and the Nasdaq was up 2.2%. The yield on the US 10-year Treasury fell 2 more basis points to 4.045%. West Texas oil futures rose 1.2% to $58.48 US a barrel. Gold rose 0.3% to $4,129 US an ounce. The US dollar index was flat, and that meant the Aussie dollar was flat too at 64.52 US cents, and the Kiwi was down 0.2% at 56.04 US cents. Number 2. The Dallas Fed's survey of manufacturing found another easing in US business conditions to back up those views about a Fed cut, says Brian.
The general business activity fell sharply, and the outlooks also worsened. So while some of the underlying data did show an improvement in the month, they tend to be quite volatile. I think what the regional Fed survey was indicating is that there's still a high degree of uncertainty out there. We know the labour market has weakened. That does reflect softer demand from firms for labour, and as a consequence, that's showing up in what is a deterioration in business sentiment locally in the Dallas region.
Number 3. Brian is also looking out for US retail sales data for September, due out tonight, which is expected to show core sales rose just 0.3%, which is consistent with GDP growth of about 2%.
So that also fits with the view that economic activity, certainly as far as the consumer is concerned, is slowing down. And I think it will help the decision towards cutting interest rates. But even if it does come in stronger than expected, what the Fed are watching is the labour market. They're of the view that the increase in inflation from tariffs is going to be transitory. At least the bulk of the governors at the FOMC seem to be of that view. And on that basis, I don't think it's going to change market pricing materially for a rate cut next month.
Number 4. The Reserve Bank of India intervened to buy the rupee overnight, moving to stabilise it just above its all-time low of 89.49 rupees to the dollar, which was hit on Friday. ANZ economist Diraj Nim says there's 3 reasons for the weakness in the rupee. Firstly, the US dollar's broader strength in recent weeks because of doubts about a rate cut. Secondly, there's been strong import demand and a record-high goods trades deficit in October. And thirdly, there's still no trade deal for India with the US.
We are approaching the end of November, which was the initially promised deadline, but there are still no signs of a trade deal getting signed anytime soon. So I think the market is getting a bit restless about that as well. Now, all of that said, we still believe that for now, 89.50 is a resistance level that the RBI may stabilize the currency around. But the occurrence of a trade deal could still mean meaningful, even if fleeting, appreciation in the rupee. But we still believe that at least over the medium term, the Reserve Bank of India will be guided by concerns of competitiveness as far as the exchange rate is concerned, and the rupee could weaken in a calibrated manner.
Number 5. Singapore's annual inflation rate jumped to 1.2% in the September quarter from 0.7% in the June quarter. That was much more than the market expected, says ANZ's Head of Asia Research, Koon Goh.
The main reason for this increase has to do with bigger than expected increase in prices in the services sector. That's somewhat surprising, and this is certainly one area to watch because it does suggest that maybe inflation pressures are starting to build in Singapore, and businesses faced with higher costs are starting to pass those on to consumers.
Couldn't go there. Now, in our deep dive interview, ANZ New Zealand's chief economist, Sharon Zollner, previews tomorrow's rates decision by the Reserve Bank of New Zealand. It's last for the year after it cut by 50 basis points to 2.5% on October the 8th. This time, the market expects a 25 basis point cut.
Having cut 50 points, the market is now absolutely certain that they will cut 25. In fact, for a while there, the market was pricing a pretty good chance of a 50, so they've backed right off that. So in that regard, it would be pretty awkward, exciting if they don't cut, because the market's assuming, rightly or wrongly, that you don't cut 50 then stop. That would be bad driving, essentially, unnecessary volatility. So I think the Reserve Bank would think that would be well within their rights to do that because of how they framed up that 50 and how they stopped well short of promising any more. But be that as it may, pricing is what it is, and it does mean that if they don't cut 25, then the market response on the day could be quite violent.
So what would that look like?
You could see everyone rushing to fixed rates. You could see all the people offshore who have been betting on further cuts stopping out of those positions or closing out. So you could actually see conditions tighten quite a bit. And I don't think that would be what the Reserve Bank would want at this early stage of the cycle. So basically our case is that our forecast is that they will cut 25, even though their model will be telling them it's probably not necessary and there is a risk it might be a bit much, but that they will nonetheless have to sort of do a hand wave in the direction of further cuts, because the market is still got another 15 points priced after a 25 this Wednesday. So that is a slightly better than even chance of another 25-point cut in February, which we are not forecasting and don't expect to be delivered. And I wouldn't expect the Reserve Bank is thinking they'll be cutting again into next year either. Though, of course, never say never. You don't know what the data's going to do. But if they were to sound absolutely definitive that they're done, then that could also see a little bit of a bounce in rates on the day.
Could the Reserve Bank cut 50 basis points?
They could cut 50, but we think that's pretty unlikely given what they said at the last meeting. It sounds like they would have had to have some reasonable downside data surprises, and they haven't. So in terms of the big uncertainty, in terms of how things will land, I'm pretty confident they'll cut 25 because they're markets, people will tell them that if they don't, it could get very messy. And at the end of the day, 25 points is neither here nor there, really.
So what's changed since the last decision?
One thing I am wondering about is how many businesses they've spoken to in the last 4 weeks. Because the monthly data hasn't changed a great deal, but the anecdotes most certainly have, and in a really wide-ranging measure. So basically every sector, agriculture is dancing to its own tune. It's been incredibly strong and is now coming off that. In fact, we've just revised down our dairy payout forecast. So they're probably past peak confidence and coming down the other side now. But all the other sectors of the economy, the anecdotes are of a sudden lift in experienced activity. The retail and everything are saying, oh, wow. And then builders are saying, phones ringing, the ports saying that import demand's picking up, etc. So it's quite widespread, the anecdotes that I'm hearing as I travel around and talk to businesses. But I don't know how much of that the Reserve Bank has done this round. And in terms of the actual data, I mean, yes, it's turned higher, but sort of just in a right, well, we can be sure the bottom is in kind of way, rather than a wow, that was strong. The PSI, for example, still under 50, so still well under par.
That sounds tricky. The animal spirits are lifting, but it's not in the data yet.
Turning points are just a little bit messy, and they'll probably stay messy for a while. Even as people become convinced that things are now on the up, there's going to be a lot of uncertainty about whether things are crawling higher or leaping higher. And of course, the Reserve Bank now has a big break, 12 weeks before they meet again. So I think their incentive is to set things up such that the next meeting they will have all their options open to them, but probably won't have backed the new governor into a corner in terms of having to do anything at all. So it could be an interesting day. 25-point cut, overwhelmingly the likeliest outcome. But if they were to surprise, then I would pick no cut as likelier than a 50, simply because we haven't had any downside surprises.
Sharon Zollner there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, November the 25th. Catch you tomorrow with a deeper dive interview with Koon Goh into what the Monetary Authority of Singapore might do next. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.